Understanding comparative market analysis is very, very important for any real estate investor. You need to become the expert in your local market. You need to understand the CMA. You need to understand the average market price, the comparative market price, and understand the CMA overall. If you know the values of the houses, what is the median price, and whatever is being sold below the market price looks like a bargain right away to you, then you have a higher chance of reacting to the market and getting the deal in hand than waiting to do the analysis and trying to see it. So it's very, very important as real estate investors that we know that what the market rates are, what's below market, what's above market. So when we're putting the offers, we know exactly if we are above or below the market. MCA is another name for Comparative Market Analysis, CMA. A CMA is critical to the pricing of new housing sales because it helps you figure out the market prices and figure out the competitive offers or competing offers. You know if the offer is above market rate or below market rate and how much should you put on the offer. Real estate professionals employ the process to determine the market value. In Canada, realtors have access to MLS HPI, Home Price Index, indicating the market price for that is pretty accurately using this software. In the US, there are a number of softwares available, the Top Producer and the Cloud CMA. When you're doing a CMA yourself, you need to get all the information about the property. If you are interested in finding some properties, keep it as simple as possible and add similar properties as much as you can so that you can get the rough market value of all the properties falling into the same category, and look at all the property information to see if it is still available. And expanding your target market to prospective market frees you up from the existing limits. Like if you expand to the neighboring markets and to see that the marketing properties give you a more wider perspective, and you have a better chance of finding the target property that you want with the criteria that you want. So when you are analyzing a property, it's very important for you to, number one, look at the location. What's the location? Is that a good location? Is it near to the schools? Is it near to hospitals? Is it near to workplaces? Is it near to transportation? You have to look at the location. The next thing you look at is, what's the total area? What's the square footage of the house overall? What's the lot size? How big is the lot? How wide is the lot? How deep is the lot? And if it is the acreage lot, how many acres are in the lot? On top of that, you have to calculate how many bedrooms are there and how many washrooms are there. Are they full washrooms, half washrooms, or are they just powder rooms? What year was the property built? And were there any recent renovations or upgrades done to the property, like finishing on the basements or finishing of the outside? Was the major repairs done, like, ceilings, roofs, whatever needs to be, like furnaces and all that? Were they recently replaced, or anything major expenses was done? How's the interior design? Were there any upgrades interior? Are there any special characteristics to the house, like swimming pools, hot tubs, etc.? The next important thing that needs to be done is gather the tax data of the property. Means what are the annual property taxes? Are there any increment in taxes expected? Gather all the tax information in the local community, because it's very important. Taxes vary from region to region, subdivision to subdivision, house to house. It depends on the recent sales, if were there any recent sales. Home value taxes depends on the property and the recent sales in the area. Cities must impose these taxes very simply to provide public services, their revenues. They do what is called abbreviated appraisals of each lot or each property that falls into their under jurisdiction. So these quick appraisals are not physically done. They are done over the computer. These are paper only appraisals. So they do not tend to be very accurate because they do not take into the account of physical walk-in into the property where you have added the extra features into the house or extra renovations or which have been added. These are not taken into account in the paper appraisals. So this can help you compare to the markets. And it gives you a clear indication when you are comparing it to the final appraisal value, what the city assessment value is. It will give you a clear indication that roughly this percentage is the CC assessment of the actual market value. So in majority of the properties in GTA, normally the properties are valued at least 30% more than the city assessment. So it depends on region to region. It depends. So you have to understand and analyze what is the ratio between the actual market value and the city assessment. Property tax assessment and property taxes. The higher the millage rate, the higher the taxes. So what is millage rate? Millage rate is basically 1,000% of a dollar. Let's say if for $1,000, if there's a $10 tax, that means there's roughly 1% tax. So the higher the millage, the higher the property tax is going to be. So how much is the tax for every $1,000? So that's millage. The higher the taxes are levied on the people, if the millage is higher. Taxes are higher, less values do the properties receive in return. The reason for that is people can afford only so much. If the taxes are higher, the affordability is lower, people are willing to pay the lower price. Okay, it doesn't mean that expensive houses have lower value. They have higher taxes. That doesn't mean it. What it means is in the same category, if the tax rates are high, the affordability, the higher the tax rate goes, the less is the affordability, the less people are able to afford, so the less will be the value that you will receive in return. So in return, this effect is magnified and has a disproportionate effect on the prices of the houses in the domestic market. So if the taxes are raised, it overall affects the value of the houses. The number is significant because you can use it to remember. So like the property tax assessment is a very significant number. It gives you approximate value of the property because you know roughly what's the ratio between the actual market value and the assessment value. And then use it to compare with the final assessment. That will give you a clear indication if you are above the norm or below the norm. When you're looking at a property and trying to analyze or find a CMA, it's very important to look at the sales history of the property. How much was the property bought for? How much was it sold? When was it sold? And so on. So this sales history will give you a clear indication of the assessment value. So the property value depends on the sales and how quickly the properties are selling in the area. Are they selling fast? Are they selling slow? Find out how much is your property worth by looking at the other current market data and about the current sales in your area. It's necessary to collect the sales data from more than one market to help you study the market comparison properly. That way you understand which area is doing good, which area is slow, which area is fast. So this helps you as a real estate investor to look at the properties and understand how much time it's going to take me to sell this property, how much time it's going to take me to rent out this property. So that will give you a clear indication. Appraised houses. The data in the appraisal forms or appraisals is very essential. The reason for that is if the overall cost, let's say for example, in your neighborhood has risen by 6% in the last 3 years, and imagine yours has gone up by 3%. If the price of the previous house is sold and the general movement of the market shows that significant indicators, the conclusion is that there's an upward value trend. That means because overall they had increased. So your house prices should increase if it hasn't gone up because your neighborhood or your other houses in the neighborhood have gone up in value. So when the price is right and a quick sale implies that it's accurate and slightly below the market. So if a house is listed on the market and sells pretty quickly, it can indicate that it was listed either below the market or on the market rate, depending on how fast it was sold and if there were continuous other sales of similar type. Spotting and seizing the opportunities. Historic data of the past 5 years is very helpful because it may be applied to the future sales of the property. Having a well-integrated market analysis is critical when you research the market because it gives you a clear picture of what was sold, how it was sold, how long it was on the market, and for how much it was sold. The use of the market data to gauge the competition, to gather the property information, and identify potential purchasing opportunities. And you can only seize the opportunities when you see them. You can seize those opportunities because you are able to now see them very clearly. Real estate investors miss a lot of opportunities because their mind and eyes are not trained well enough to see those opportunities. Studying the sales and the availability data opens your eye to those opportunities. So when you are studying the history of the house, there are various reports in terms of on the condition of the house. If you look at the previous appraisals or previous reports, any significant changes that had occurred in, let's say, in the last 5 years. So you need to look at that data, and the last time the listing being provided, what was the overall state of the property and the historical information, how many bedroom, how many washroom, was there any addition in the last few years or not. Before making comparative market analysis, it's critical to understand the historical data and the current sales data because that will give you a clear indication if you are buying below market or above market. After seeing those recent sales figures, you will be able to use those figures to get a clear approximation. Means you will know what should be your sales price, what should be your market value of the house, of the property that you're analyzing. Market change. Market is ever changing. So when you are trying to purchase a property, you need to study the category of the property you're trying to buy, find similar 4 to 5 houses that were recently sold and whether they have the recent 5 property that was sold, were they close enough to give you an idea of what to offer. Many people realize that the market is ever changing, which means the best information is only a few minutes ahead of the trend. So it's very, very important for you to understand this information, and it's very important for you to be able to analyze the data and understand what adds how much value. So if your subject property has been in some major metropolitan area, the property is likely to be in a similar state, in a similar condition. So you have to look at all those properties which are very similar to you and look at their prices. The result of this practice is likely to be roughly the same, because if you are looking for similar properties in a similar neighborhood, they should have roughly similar prices. If the properties are a little bit in a smaller neighborhood, they can be a little bit overpriced because smaller properties normally a little bit higher per square footage in terms of, you have to understand that, than the other similar properties. So if your property is a little bit overpriced, that will put a little bit constraint when you're trying to sell. Some searching tips here. So when you are searching for a property, it's good to search in various domains. And once you start the search, it's very important for you to focus on specific type of property instead of just general. And when you're searching, so you have to look at one type of property, one type of investment, so it rather than several types at the same time, because that will give you a comparative analysis, that will give you a comparative market analysis to show you which property is below or above the market value. Because if you are comparing apples to apples and you know which property is cheaper per square footage, so if you calculate the per square footage value of the similar houses, yes, there can be a variance of 10, 15, or even maximum 20% in terms of square footage, because it's very hard for you to find exact square footage of two houses. But if you can find within a 10-20% variance, that's fine too, because they fall into the similar bracket, and you want to make sure that you know the per square footage price. If you know the per square footage price, and then once you take out per square footage price of all the properties that are on sale, you know which one are above market, which are below market, which are median. So it's very important for you to understand the actual market rate and what you should be paying for your property. Analyzing comparables. Compare the comparables to the subject properties to calculate the differentials and come up with the adjusted value. How much can an adjusted or expanded or similar property to this property may be purchased for in the current market? Contrast the recent listed properties and recently sold properties and figure out what the demand is for and what's available. Your business is to identify the properties on the market today and those serving as the bedrock for your organization. You must know the prices of the properties that were sold, in addition to the time it took to get them to the market and time it took to sell them and how long they were under contract. It's imperative to mention everything significant about your home in the comparison, be it one thing that's missing from the other properties or otherwise. Even though you may have an unexpected real estate hiccup, you need to communicate everything that you notice with the agent on the listing of the comparative property, because any additional feature may add value, because somebody may like certain feature and your property might become attractive to them. Steps to analysis. Start your study with the property's history, which will give you the exact date the property was listed, the exact date when the property was sold, how much was it sold, the amounts of the sales, and what kind of mortgages were on the properties. This will give you the full background in terms of the history of the property. And when your property is recently sold, the rising and falling of the rate along with the market rate, was it an average fall, was it an above market fall? So dip in the markets and see how they present themselves. If you have done some preliminary background research, you should be able to guess the trend. You should be able to find out those three numbers, the highest, the lowest, and the median prices of the properties in your area. Use your numbers to ascertain multiple micro market trends and apply those trends to your models that should lead you to the arrival of the prediction price. There are only two answers whether or not to conduct a CMA research. There is a need for it or there's no need for it. When you understand the valuation process better, you can determine how much is your property worth in the marketplace. You will know what factors and what features affect the market value, and your seller's prices become more accurate, and your sales prices, your listing prices become more accurate, your offers become more accurate, and you understand where you stand in the marketplace when placing the offers, whether you expect a profit and how much you expect as a profit. There are a lot of softwares available these days in terms of doing the CMA. You don't necessarily need to do everything manually, but it's very important to understand the calculations, the thinkings behind it. So it becomes very easy for you when you're doing an offer to consider the factors so that you know what factors, what features are affecting the market value.